XRP holders, pay very close attention right now because what I'm about to walk you through is not hype, it's not a prediction, and it's definitely not a promise. It's a sequence of events, signals, and shifts that most people completely miss because they're too focused on price candles instead of structure. And if you're still watching charts every 5 minutes, you're already looking in the wrong place. Before we go any deeper, take a second and hit the like button if you value calm, intelligent market discussions without fear tactics. And subscribe if you want content that focuses on understanding what's happening behind the scenes, not just reacting to headlines. That support helps this channel continue delivering clarity instead of noise. Now let's slow this down. For years, XRP has existed in a strange position in the market. Too institutional for crypto purists. Too controversial for traditional finance. Too resilient to disappear, but too misunderstood to move cleanly. And yet, despite all of that, it keeps showing up in places where serious money pays attention. Recently, a shift in tone caught a lot of people off guard. Not because of an announcement, not because of a flashy press release, but because of something far more important: behavior. When institutions change behavior, it matters more than words. Morgan Stanley is not a hype-driven firm. It does not move based on social media sentiment. It does not flip in the emotional way retail traders do. When a firm like that adjusts how it talks about, evaluates, or positions around digital assets, it's never impulsive, it's procedural, it's cautious, and it's slow. That's why people who understand markets don't look for excitement, they look for alignment. Now, let's be very clear, this video is for informational and educational purposes only. Nothing here is financial advice. There are no guarantees in markets, especially crypto markets. Anyone telling you otherwise is selling certainty, not truth. With that said, let's talk about what happens when large financial institutions begin recalibrating how they think about digital infrastructure. First, understand this. Institutions don't chase price. They chase systems. They care about liquidity, compliance, scalability, and integration. They don't need an asset to be exciting. They need it to work. And that's where XRP has always been different. While most crypto narratives revolve around decentralization as an ideology, XRP was designed around efficiency as a function. Faster settlement, lower cost, interoperability. These are boring words to speculators, but they are essential words to banks. The mistake most people make is assuming that institutional interest looks loud. In reality, it looks quiet. It shows up in internal research notes, in pilot programs, in language shifts during earnings calls, in how assets are categorized, not how loudly they're promoted. Retail traders often believe that institutions move after price. Historically, it's usually the opposite. Price reacts after positioning, not before. So when you hear phrases like, "this happens next," understand that next does not mean tomorrow morning. It means next in sequence. Markets move in sequences, not moments. And right now, the sequence around digital assets is changing. For a long time, crypto lived in a gray zone, too big to ignore, too risky to embrace. That uncertainty kept many institutions on the sidelines, not because they didn't see potential, but because they couldn't justify exposure without clarity. Clarity changes behavior. That's why regulatory conversations matter, even when they feel slow or frustrating. They don't create excitement, they create permission. Permission is what institutions need. Another thing most people overlook is how financial firms think in layers. They don't jump straight to exposure. They start with understanding, then modeling, then limited engagement, then integration. Each layer can take months or years. If you're waiting for a headline that says everything changed today, you're misunderstanding how this works. The real shifts happen before the headlines, and this is where XRP becomes interesting again. XRP was built to sit between systems, not replace them. That design choice made it unpopular with certain parts of the crypto community, but attractive to entities that live in the real financial world. Banks don't want revolutions, they want upgrades. Now, think about this for a moment. Cross-border payments are still slow, expensive, and inefficient. That problem hasn't been solved, it's been tolerated. Any technology that meaningfully improves that process without breaking compliance becomes relevant, not because it's trendy, but because it reduces friction. Reducing friction saves money. Saving money at scale is everything in finance. This is why XRP continues to appear in conversations long after other projects fade, not because it's loud, but because it fits into existing frameworks. Another key point that needs to be said clearly is this. Markets are not moral systems. They are incentive systems. They reward what aligns with structure, not what feels fair. Retail traders often feel like markets are out to get them. In reality, markets don't know they exist. Markets respond to liquidity and flow. This is why price movements often feel manipulative. It's not personal. It's structural. Large players need liquidity to move size. That liquidity often exists where retail places emotional bets. Understanding that doesn't make you immune to volatility, but it does make you less surprised by it, and surprise is what causes panic. Now let's talk about narrative timing. Narratives don't shift when something becomes true. They shift when enough people are ready to hear it. XRP has been associated with legal debate, regulatory pressure, and skepticism for years. That narrative didn't disappear overnight. It slowly lost dominance. As uncertainty fades, even slightly, evaluation replaces dismissal. That's a massive difference. Evaluation doesn't mean endorsement. It means consideration. Institutions don't need to believe in a perfect future. They need risk to be quantifiable. When risk becomes quantifiable, behavior changes. That's the context most people miss. If you're watching this and feeling a mix of curiosity and caution, that's healthy. Anyone telling you to feel certainty is lying. Markets don't reward certainty. They punish it. They reward preparation. Another mistake people make is assuming that if something hasn't moved yet, it won't. In reality, markets spend far more time accumulating and distributing than trending. Trends are short. Preparation is long. This is why people who chase excitement often feel exhausted, while people who understand structure feel patient. Patience is not passive, it's strategic. XRP's journey has forced patience on its community. That doesn't guarantee future success, but it does mean that anyone still paying attention has already survived multiple stress tests. Stress tests reveal durability. From an institutional perspective, durability matters more than popularity. Now let's address something directly, because it's important for YouTube policy and for your own protection as a viewer. No one can tell you what price XRP will reach. No one can tell you when anything will happen. Any video claiming certainty is engaging in speculation, not education. This video is about understanding shifts in behavior and structure, not predicting outcomes. If you appreciate that approach, again, make sure you're subscribed. This channel prioritizes clarity over clicks. What happens next in this story is not a sudden explosion, it's a continuation of alignment. Alignment between technology, regulation, and institutional readiness. That alignment takes time, and time is the one thing most people underestimate. We live in a world trained for instant feedback. Markets don't operate that way at scale. The biggest transfers of value in history did not happen in moments of excitement. They happened during periods of boredom, doubt, and disbelief. That's uncomfortable to accept, but it's true. Right now, XRP exists in a phase where conversation is becoming more measured, less emotional, more analytical. That shift alone is meaningful. As we move forward in this video series, we're going to continue breaking down what these changes mean, how institutions think, and why understanding structure matters more than chasing headlines. If you're here for fast promises, this isn't the place. If you're here to understand what's actually happening beneath the surface, you're exactly where you need to be. Take a breath. Step back from the chart. Focus on systems, not noise. Because the people who understand the system are never the ones panicking at the screen. And the reason this story is just getting started is because institutional shifts never announce themselves with fireworks. They reveal themselves through consistency, through repetition, through subtle changes that only become obvious once you connect enough dots over time. Most people wait for permission to believe something has changed. Institutions don't wait for permission. They wait for conditions. And one of the biggest conditions they look for is stability under pressure. XRP has been under pressure for years. Legal pressure, narrative pressure, market pressure, and yet it continues to function exactly as designed. Transactions settle. Liquidity moves. The network doesn't stop because sentiment shifts. That matters more than people realize. In traditional finance, stress testing is everything. Systems are deliberately pushed to their limits to see where they break. A system that survives prolonged uncertainty earns credibility even if no one publicly applauds it. That's how trust is built at scale, not through excitement, but through endurance. Another important layer to understand is that institutions don't operate as a single hive mind. Different departments move at different speeds. Risk teams are conservative. Innovation teams are curious. Compliance teams are cautious. Strategy teams think in decades. When you hear that a firm like Morgan Stanley is reassessing digital assets, that doesn't mean they suddenly love crypto. It means different internal conversations are converging instead of conflicting. Convergence is powerful. For a long time, digital assets created internal tension inside large firms. Innovation teams saw potential, risk teams saw uncertainty, compliance teams saw exposure. That tension slowed everything down. As frameworks mature, that tension decreases. Decreasing internal resistance doesn't create headlines. It creates motion. This is why retail traders often feel like they're late to everything. By the time something feels obvious publicly, it's already been discussed privately for a long time. This isn't conspiracy, it's process. Institutions don't need to convince the public of anything. They need to justify decisions internally, and internal justification looks nothing like YouTube thumbnails or social media hype. It looks like reports, scenarios, stress cases, failure analysis. XRP fits unusually well into that kind of evaluation because its purpose is narrow and specific. It's not trying to be everything, it's trying to do one thing efficiently. Efficiency is measurable. Measurable systems are easier to evaluate. This is why speculative narratives come and go, but infrastructure conversations persist. Infrastructure isn't exciting until it's essential, and by the time it's essential, it's already everywhere. Think about the internet. Think about online payments. Think about cloud computing. None of these felt revolutionary once they were adopted. They felt inevitable. That's how systems win. Another critical mistake people make is assuming that institutions care about ideology. They don't. They care about utility, risk, and return. Whether a system is decentralized, semi-centralized, or integrated into existing frameworks matters less than whether it performs reliably within regulatory boundaries. XRP was designed with that reality in mind from the beginning. That design choice limited its popularity in some circles, but expanded its relevance in others. You don't need universal approval to succeed in finance. You need the right approval. And that approval doesn't come from crowds. It comes from committees. Committees move slowly. That slowness frustrates retail investors because it doesn't align with emotional timelines. But that same slowness prevents reckless decisions. Another thing to understand is how capital allocation actually works at scale. Institutions don't go all in. They start small, they test exposure, they observe outcomes, then they adjust. Small positioning doesn't move markets dramatically. That's why early institutional involvement often goes unnoticed. People expect the switch to flip. Markets don't work that way. They warm up, they test, they adapt. Now let's talk about why phrases like "this happens next" can be misleading if misunderstood. Next doesn't mean immediate. Next means sequential. Before large-scale adoption comes validation. Before validation comes experimentation. Before experimentation comes observation. We're still in observation for many institutions. Observation doesn't mean inaction. It means watching closely without commitment. And watching closely is exactly where the most important thinking happens. Another layer that's often ignored is generational transition inside financial firms. Decision makers are changing. New leadership grew up with digital systems. They're not intimidated by technology. They expect it. That generational shift doesn't replace institutions. It reshapes them. As that shift continues, conversations around digital assets become less defensive and more analytical. Analysis leads to modeling. Modeling leads to scenarios. Scenarios lead to decisions. This is the path. XRP's role in that path isn't guaranteed, but it's plausible. And in finance, plausibility is enough to justify attention. Attention is the most valuable resource in markets. Price follows attention over time, but attention doesn't always follow price. That's the inversion most people don't understand. If you're only watching price, you're watching the last step in the process. The earlier steps happen quietly. Now let's address emotion again, because it plays a massive role in how people interpret information. Fear makes people seek certainty. Certainty doesn't exist in markets. That's why people gravitate toward confident voices even when those voices are wrong. This channel doesn't promise certainty. It provides context. Context doesn't eliminate risk, but it reduces confusion. Confusion is the most dangerous state for any investor. Confused people react. Prepared people respond. XRP's long consolidation period periods have been emotionally exhausting for many holders. That exhaustion causes people to disengage right before narratives shift. That pattern repeats across markets constantly. It's not malicious, it's human. Markets exploit psychology without intention. They simply reflect it. Understanding that doesn't make markets predictable, but it makes them survivable. Another point worth emphasizing is that institutional involvement doesn't mean immediate upside. It often means reduced downside first. Stability often precedes growth. Stability doesn't generate excitement, but it creates foundations. If you're expecting fireworks, you'll miss foundations. Now let's talk about what institutions actually fear. They fear reputational risk. They fear regulatory backlash. They fear operational failure. They do not fear volatility the way retail traders do. Volatility is manageable. Reputation is not. XRP's public journey through scrutiny, debate, and legal processes has forced it into a level of transparency most projects never experience. That transparency is uncomfortable, but it reduces unknowns. Reduced unknowns reduce risk. Reduced risk enables participation. This is how systems evolve, not through belief, through tolerance. Tolerance grows into acceptance. Acceptance grows into usage. Usage eventually reflects in valuation, but valuation is the end of the story, not the beginning. Most people try to read the ending without understanding the plot. That's why they feel lost. If you're still watching, take another second and hit the like button. It signals that deeper conversations matter more than noise. And subscribe if you want the rest of this series without interruption, because what we're doing here is building understanding step by step. In the next part, we're going to go even deeper into how market narratives shift, why retail sentiment often lags institutional behavior, and what signals actually matter when watching developments around XRP, not predictions. Signals. Signals don't tell you what will happen, they tell you what to watch. And knowing what to watch is half the battle. This story isn't about a single firm or a single moment. It's about a system slowly adjusting to a new reality. Whether XRP becomes central to that reality or simply part of it remains to be seen, but the fact that it continues to be discussed at high levels tells you one thing clearly: it hasn't been dismissed, and in markets, not being dismissed is often the most important step forward.